Welcome to Man in America. I'm your host, Seth Woolhouse. So the big question right now is, who do you really trust in terms of the government, the big agencies, etc.? And I'd say that most people don't really trust that many of them. But I'd imagine that you probably have a lot of your money sitting in the bank account. So I think a lot of us still trust our banks. Well, of course, because they're insured by the FDIC, right? That big federal thing that makes sure that the money that the banks say is there is actually going to be there. Well, if there's anything we've learned in the past couple of years, is that you can't trust these giant monolithic structures, whether it's big pharma, big government, or even the big banking system. And so there's a video that was leaked or something of a private meeting of people discussing, these high-level bankers discussing the FDIC, and it's pretty damning to say the least. So we're going to be covering this today with Kirk Elliott. Before we get started though, folks, make sure you're following me on social media at Man in America. Also, every show is also a podcast. So to listen to the podcast, just go to your favorite podcast app and search for Man in America. And if you really want to win my favor, please leave me a 5-star review. It really helps me to reach more people, and I really appreciate it. All right, folks, let's go ahead and bring on Kirk Elliott for today's fun interview about banking. All right, Kirk, welcome. It's good to see you.
Hey, it's good to see you. Happy New Year.
Yeah, Happy New Year to you. Absolutely. So, before the show, you and I are talking about what's happening in the news. And it's like, okay, we have the IRS stuff happening, which we know is really just a pipe dream. It's like, okay, maybe if we had Trump in office and we had control of the Senate and the House, maybe we could abolish the IRS. But I think that the IRS abolishing thing is really just a way for politicians to get more money from us. But you said, look, Seth, there's a huge news about the FDIC. And so I'm going to pull up the article that you sent me. I'm going to give a quick read of a few points of it. And then there's a short video we're going to watch. And then I can't wait to hear your explanation. So this is the article you sent, which is on G. Edward Griffin's blog, Need to Know. If you don't know who Griffin is, he's the guy that wrote the book, The Creature from Jekyll Island, which I highly recommend you read because it really explains the entire corrupt banking system in a way that's better than anything else I've found. So, but in this article, he says here, FDIC bankers discuss bail-ins to deal with impending market collapse. All right, and there's a video we're going to play, but so here he goes. So the Federal Deposit Insurance Corporation, FDIC, officials recently discussed how to deal with the next approaching market collapse and hide alarming data from depositors to prevent bank runs, video of a meeting shows. And so here's the tweet from Wall Street Silver. Now, the video itself came out back, the meeting was back in November, and the video started spreading around in the past week or two, but it's really picked up steam. It's now getting noticed. And this is the kind of information that we have to get more people to understand. So Wall Street Silver says in this tweet, he says, they don't want the public to see this video. The bankers don't trust the banks. They're talking about financial crisis and their lack of faith in our banking system and how to keep the public from freaking out. Now, keep in mind, this is the FDIC people that are having this discussion. So I'm going to play this video for you real quick. It's about a minute and a half, and then I can't wait to hear what Kirk has to say about it.
It should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do, that we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in, they're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that will charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
So, Kirk, walk me through, what are these guys talking about?
All right, so let's define some terms first, right? So, because words matter, right? And words have meaning. So, the FDIC, what is the FDIC? It's the Federal Deposit Insurance Commission, right? It's when we put money into our bank, into our checking savings account, right? It's got FDIC coverage up to $250,000. So that's the insurance that we have just in case there's some kind of a failure in the markets, like in 2009 or whatever, right? And a run on the banks, whatever it might be, that, hey, if we have less than 250,000, we should get it all back because that's the insurance. Okay, so that's FDIC. Now they're discussing bail-ins in this meeting to deal with an impending market collapse. Okay, impending market collapse. It's not like maybe there's going to be a collapse down the road sometime, right? No, impending. Words have meaning. So they're acknowledging the fact that there is a collapse that's coming, and it's impending. It's right around the corner, right? So then what's a bail-in? So a bail-in is just like a one-off tax from the government. We've seen this in Cyprus. We've seen this in Greece and in Argentina, right? Where if the government needs money, they'll say something like this: "Hey, Mr. and Mrs. Americans, you're so glad you're part of our country. We've made you a life, right? We've established your freedoms and this and that. So, but we need money, and so because we've given you so much, you're going to pay us, right?" So that's what all it is stealing money from somebody, and people don't have a choice. You know, it's not a tax that some people pay and some people don't, right? And they, whatever. But it's like, okay, they're just automatically going to take it out of your accounts, out of your brokerage accounts, checking accounts, savings accounts. That's what a bail-in tax. So it's a forced tax that pays the government.
So a bail-in could be, hypothetically, let's just say that the government says there's an emergency, there's a financial crisis, and we're now going to take 20% of all assets that people are holding in their checkings and savings accounts, right? Where they basically just seize your money. And that's what you call a bail-in. Is that correct?
Yeah. So if they're going to do a bail-in tax tomorrow of 20%, you had $100,000 in your checking account tonight. Tomorrow you're going to have 80,000. They can just take it out. This becomes really, really easy under central bank digital currency in the digital world that we're moving into, right? I mean, it'll be super easy, but it's already easy enough because it's a digital asset. They know what's there. So that's what a bail-in is. It's just like this forced tax that they just take, right? Okay. So that's what they're talking about in this meeting, is an impending market collapse, and they're talking about bail-ins, right? So what is this group that was talking? So the FDIC has a subgroup called the Systemic Resolution Advisory Committee, or SRAC. So they held a meeting back in November. This is the video that's just now becoming public. And if you look at it, this video, I don't know who took the video, but it's like it started midstream in a sentence. So whoever took it, it's probably like thinking, oh my word, this is some juicy stuff right here. I better get this on video, because it was like done from the side angle and, it just wasn't professionally done. But anyways, they held a meeting in November to discuss how the next market crash, again, words have meaning. We had a market crash in 2000. We had one in 2009. There will be a next one, right? How it would occur and what steps would need to be taken to ensure that not everybody tries pulling their money out of the financial system at the same time. Okay. That's the unintended consequence, right? Of what they were trying to protect from is, we can't get this news out here. We'll talk about what the news is, because if people find out, they could pull all their money out of the bank. There might be a bank run, and that we can't afford that unintended consequence, right? So one of the FDIC guys that was sitting there, he said, well, institutions are soon going to be able to figure out the dire implications of a financial collapse, right? But the general public shouldn't know about this. They shouldn't know. So what is it that none of us are supposed to know that we shouldn't know, right? So all of the checking account, savings accounts, all the bank stuff that we have in the banks equals $9 trillion. That's all of our deposits added together as Americans is $9 trillion. The FDIC, the insurance that's supposed to cover that, has $125 billion worth of assets. So you do the math. 125 billion divided by 9 trillion, that's 1.388% of all deposits. That's all that the FDIC has, right? So forget the whole concept of, hey, your deposits are insured by the FDIC up to $250,000 per account, right? Baloney. They only have 1.388% of all deposits. And so that account is so underfunded that this is why they're concerned. If there were a run on the bank because people knew this issue, there's not enough insurance to cover people's losses, right?
So
there's not, and so, but here's the issue. Banks don't have liquidity, right? So you go back to last year. In the summer, the Fed actually changed the reserve requirement. So this is why that's so easy to have run on the banks. So normally, if you deposit $100 into your checking account, the bank will hold some back and then they'll lend out some, right? So if the reserve requirement's 10%, for every $100 you put in, they're going to keep 10 and they lend out 90. That's fractional reserve banking. And of that 90, they'll keep 9 and then they'll lend out 81, right? So it just keeps going down. They just keep back 10% of every deposit. Now, so in the summer, the Fed changed the reserve requirement to 0%. So banks don't have to have anything on hand at all. They could just take their balance sheet down to zip, right? So what you're seeing when you see your checking account and savings account balance online, it's a ledger entry, right? It doesn't mean that it's actually there. That's what you put in on deposit. They're lending it out and they're just hoping that not everybody comes back at the same time to get it out on the same day because it's technically not there. And it's so bad right now because the reserve requirement is 0. Well, to amplify that badness, right, is the fact that during COVID, the Fed did what's called the reverse repo mechanism. It's a repossession mechanism where they actually gave banks worthless US treasuries and they stripped cash out of the system. So they took $2.5 trillion of cash out of the banking system at a time when banks needed to lend out money the most, right? When people were hurting, when mom and pop stores didn't have enough money, there was no cash there to actually lend. Why did the Fed take it out? To this day, who knows, other than maybe they want a different system. Maybe they're forcing this issue of getting people to not trust the bank so they can usher in a central bank digital currency, right? I mean, I'm speculating here, but all that we know is that they took $2.5 trillion out of the system last year and the reserve requirement 0. So there's now no money on hand. So now when people find out that there might not be any coverage of their deposits, and they go to take stuff out and there's not enough there, boom, bank failures everywhere. It's like the movie that I saw over the holidays, It's a Wonderful Life, right? When they go to the bank and it's
yeah.
I mean, perfect example of a bank run, right? And what happens when a bank closes and people can't get their money out. We're seeing the same thing in China right now, where the Chinese banks have run out of money. Chinese citizens are trying to get their money out and the Chinese government says, sorry, you can't get it.
Yeah.
Right. It's like, well, why can't we get it? Because we don't have it. Same thing here. So this is the problem. So what could be the end result of that? Well, I would say if there is a bank run in 2023, because of whatever reason, this could be a reason that would cause a bank run and there's no money there, it would be the mother of all quantitative easing. I mean, the Fed would print $5-7 trillion, whatever it would take. And we think we have inflationary pressures now, Seth. You had the lame duck Congress that just passed a $1.7 trillion spending bill. All right, with money that we don't have. So I wouldn't have an issue with it if we had $1.7 trillion laying around and all that was an appropriations bill. But they don't have it. They passed a spending bill with money that we don't have, which means they're going to have to print that. Why? Because they don't have enough government revenues. Like at the beginning of the show, we were talking about the IRS, right? So the IRS brought in $4.89 trillion last year in 2022. That's the federal tax revenues. That's all of our taxes that we pay equaled $4.89 trillion. How much did we spend under Biden's amazing economic plan with America? We spent $6.27 trillion. Brought in 4.8, spent 6.2. That's almost a $1.4 trillion deficit. They just added 1.7 trillion on this spending bill. Then if you got to do a big bank bailout because there's a potential run on the banks, it's like, oh my word, when are we going to stop counting all the stuff in trillions? I mean, seriously, we are in a world of hurt because there's no liquidity in the financial system. And when there's no liquidity, the banks aren't lending out money because there's no money to lend out, which means it's going to be harder for hardworking Americans and business owners and small businesses to actually expand, to get money for inventory, short-term loans, buy a house, right? Now the interest rates are going up. It's even worse because people can't qualify, right? And the banks are saying, okay, because we have no money, we can't really afford for people to not pay this stuff back. So for you to even get a loan, let's try a credit score of maybe 780 or 800, right? I mean, they're bumping up the requirements because they don't have enough money, which makes it harder and harder and harder for people to actually just survive, right? So this is the world that we're living in right now.
And so, gosh, I've got a lot of different questions and thoughts. So to make sure I understand it correctly, it's almost like this. Okay, let's play a scenario. Let's imagine I took $1 million to my local bank and I gave that money to the bank. Here's a briefcase full of cash. They're going to deposit it, that'd be great. Unfortunately, that's not what my life looks like. The same with most Americans. But I would then log into my bank account and I would say, okay, I have $1 million in my checking account. Now, in the past, the bank would have been forced because of the requirements to hold on to a portion of that money, right? 5%, 10%, et cetera. But now there's no requirements. The bank can literally take that $1 million and give it to somebody else. So this guy wants a loan for his business, right? They can just give it to the other guy. Okay. But they're telling me that, well, at least $250,000 is insured by the FDIC. And so it's like to me, it looks like it's like a multi-level Ponzi scheme where they're taking from one person, lending to the other person. They're giving you this idea that your money is safe because it's all protected, but it's not until the music stops that you realize like that's not there. Because if that bank is then reliant on the FDIC that's protecting its, the assets of its people, but then the FDIC, as you're saying, only has about a 1.4% of the overall, they're over leveraged that much that one way to look at it is it's kind of like if right now, if let's just say that, and this is a very simplistic kind of way of looking at it, but let's just imagine that everybody in America that had under $250,000 in their bank accounts, right? If all of us went to the bank on the same day to take out all our money, and that money had to be, say the banks obviously wouldn't be able to support that because the banks don't hold that kind of money, and it was reliant on the FDIC, that only about the first 1.5% of people that actually got there would get their money, right? And that 98.5% of people would be told that we don't have any more money. So it's almost like the entire financial system is bankrupt. But like what these guys are talking about, they don't want us to know that because the public would freak out because the public still, it's like somehow like we don't trust big pharma anymore, yet we still trust government banking. You know what I mean? Which is, I think it's actually far worse. You think big pharma is bad. Let's go into the banking system. But is my simplistic way of looking at it, is that correct?
So it's 100% correct. So somebody puts $1 million in, the bank then lends it out $1 million to somebody else. Then they could lend it out to somebody else, right? I mean, it just keeps going on when you have to hold nothing back, right? So in this example, $3 million was lent out on a $1 million deposit. Okay, now that's the magic of fractional reserve banking. So of $1 million at 1.4%, how much of that is insured? $14,000. What's the FDIC insurance? $250,000. So they only have enough money to pay $14,000, right? But if there's a bank run and they've lent that out 3 times, just 3 times, but How many times did they lend it out? It could be infinite number, because how many clients do banks have? Thousands, right? So they keep lending out the same money over and over and over again, just hoping that not everybody comes back and pulls it out at the same time. But in this scenario, that basically $3 million would evaporate under FDIC insurance. Normally 750,000 would go back, but they don't have that. They only have 14,000 per client, right? So it's a pickle. But even when it was better, when they had a 10% reserve requirement, well, that's still only 10% of the people would only get a fraction of money, right? Because if they're lending out 90%, so even back then it wasn't good, but right now it's just toxic. It's just terrible, because the economy got so bad during COVID that the Fed was forced to lower the reserve requirement to zero to get all the money out of the system that they could, try to get it into people's hands as much as they could, right? But all that did was amplify this, and it reminds me of the old adage, the bigger they are, the harder they fall.
Yeah.
This one could be a doozy, because literally 0% reserve requirement. They took $2.5 trillion out of the system. FDIC only has 1.4% of people's deposits on hand. So just an ugly turn of events could happen.
And so these bankers, and I've been hearing from a lot of different people that 2023, they're expecting major things to happen with the market, right? And so what these guys are talking about, they're also saying, yeah, we think that the market's going to be, as you say, a crash, I believe, right? Now, if that happens, let's say that, the Dow drops 20, 30%, right, over the course of a couple of weeks, which is, I think that would be qualified as a crash, not a collapse, but a crash, right? You would probably have a lot of people that are then saying, all at once, like, because that's the trigger event, right? It's like, what's the trigger event that causes everyone to go say, hey, I'm not sure I trust my money being held by Vanguard, by, this, or sitting in an IRA, or sitting in a whatever. There's a trigger event, because it's like, okay, it's now losing money in those places. And so the people would then, a lot of folks, I would think, would then go in and say, look, like, I just want to have this as cash, right? Like, and that's the thing is, when there's an economic downturn, a lot of people I've followed have said, look, cash is king, because then you have the power to buy things as everyone's rushing to sell, et cetera. So then that would be the trigger event, which would cause people to go to the bank and say, like, look, I want, that $100,000 back. But it's like that in of itself, though. It's like, so it's kind of like a market crash could be the ignition for the detonation of, the banking system, because the crash could initiate the bank runs, which then collapses the banking system.
I mean, it's a vicious domino effect. And the way that you explained it is exactly how it would probably happen, right? It doesn't take much, doesn't take a big spark to bring this house of cards down when there's no money behind.
Well, and so the big question I'm sure a lot of the audience is asking is like, well, should I even keep my cash in the bank? And I can share just from my own personal decisions I've made. I used to bank with JP Morgan, right? Now I have one account. I think I keep like $500 in the account. So I found a small local bank. They've got maybe 5 or 6 branches in my small local area. And I now do my banking with them. So I think that's the first step, is not being in the big banks, the BOA, the JP Morgan, et cetera, moving to smaller local banks, credit unions, et cetera. But I mean, like right now, let's say I wanted to drain my bank account at my local bank. I can go in there and say, hey, can I have this? And I could literally take that cash out, stuff it under the mattress, and be like, okay, maybe I feel safe. I mean, is that what people should be doing? Like, if people have $100,000 sitting in a savings account with Chase, if there's a chance that a market crash could trigger a bank run, which would then trigger the event of me going to the bank and them saying, sorry, we can't give you that money. Should people pull that money out into cash? I mean, what do people do?
Well, not all banks are created equal, right? And so the big ones, the JP Morgans, the Bank of Americas, the Cities, the Capital Ones, all of those, they have Each one of them has probably $30 trillion plus of derivatives debt, international derivatives exposure. Not a safe place to be. Not only is it just debt, it's leveraged debt, right? And all of them, those big ones, have more than the entire US national debt per bank, right? So probably not the safest, thing if you're looking for safety, but neither is like a single one-off, I'm just making up a name, Jones Bank of Main Street, right? They only have one branch. They don't have enough capital to withstand a storm, right? I would say that's equally as unsafe. But what I would, obviously, 30,000 foot view here, because every bank has different debt to income ratios and everything. But overall, that I would say that would be an accurate statement. Now, as far as safety goes, I would think credit unions and regional banks that have like between 10 and 50 branches would probably be the safest, because the way that credit unions are owned, they're owned by their members, which are usually local. They're never going to do something crazy because they'd have a mutiny on their hands, right? And then the banks that have 10 to 50 branches, they're not too big that they have a bunch of derivatives exposure, but they're not too small, so they have some more capital to withstand a storm. So I would say credit unions and your medium-sized regional banks are probably the safest, but take that with a grain of salt too, because when the economy goes really south, all banks are going to be hurt hard, right? Because people are going to have a propensity to not pay off their mortgages, their credit card payments, their car payments, and every bank is going to feel that pinch. So it's like, what do? Well, I would like get out of the system kind of a scenario and have enough money in the bank to fund your normal operations and an emergency fund, right? So normal operations, let's say you lose your job, have 3 months of expenses in the bank would probably be adequate in cash. And then everything else, I would invest into something like silver, tangible asset that responds very, very well to inflationary pressures that we're seeing. I mean, good grief, Seth. If you look at what silver has done over the last 12 weeks, it's up 37% in a quarter. And the economists of the mining companies, like the gold miners, the silver miners, the miners don't want to mine gold or silver if they think that the price is going down, because they'll lose money, right? They're mining it at expensive costs. They don't want to sell it at lower. So their miners give them projections every year. So what were the projections that just came out this week? Well, silver, we'll just talk about silver because that's the undervalued asset. That's everything I've been investing has been in silver for the last year and a half or so, because it's greatly outperforming gold. But their projections for silver were by January of 2024, $53 an ounce. It's more than double.
From the mining companies.
From the mining companies' economists,
Wow.
their projections for the industry. And then by the January of 2025, $75.33 an ounce. So doubling this year and then going up another 50% next year, right? I mean, that's tripling from where we are today. And those numbers aren't that far off from what I've been saying for over a year of silver being $75 to $100 over the next year to year and a half, when I believe that this market will probably peak out. But now there's other economists like Bo Polney or Bixweir, some of the guys out there who are thinking $600 to $2,500 an ounce. I mean, I pray that I'm wrong for the first time in my life. I hope I'm dead dog wrong, because I would love it if silver got to $600 to $2,500 an ounce. But I'm not crying any crocodile tears over a tripling to quadrupling, 300 to 400% gain over the next year to year and a half. That's what we're looking at. Even the economists of the mining companies are saying 50 and 75 over the next year and 2 years. The CEO of HSBC, the big London bank, last quarter of last year said, hey, with supply chain disruptions, low supply, high demand, all else being equal, silver's probably going to hit $100 over the next 12 months. It's like, boom. Yeah, they're not a silver company. It's one of the largest banks in the world, right? So people are starting to see the writing on the wall, the debt implosion that we're seeing, the lack of revenue, and now some of these, so I wouldn't call this a black swan event, but these unforeseen events that come up and say, what, the FDIC doesn't have any coverage? Are you joking me? Right? I think that this is I think 2022 set the table for what 2023 is going to invite guests to that dinner that nobody wants, right? And that's,
Yeah.
I think that those guests are financial collapse and turbulence and turmoil
Food
and uncertainty
shortages.
and all of that.
Yeah, absolutely. Well, it's good to get your thoughts on this, and I'm glad that you brought this to my attention because this is the big thing no one's talking about. You turn on the TV, everyone's saying, "Oh, the House is passing something to abolish the IRS," or it's all this distraction. We've all been caught up in all that's happening in DC, whereas what's really like that the rubber hits the road when you go to your bank and you can't pull out your money anymore. So anyway, great perspective. For folks that are watching, obviously, I work with Kirk Elliott. He's one of my sponsors. If you want to inquire about buying silver or moving a 401k or an IRA into silver, doing it in a way that you can avoid, the taxes and penalties, I would highly recommend Kirk Elliott. He's who I use. He's who my family, my friends use. So goldwithseth.com is the website. And what's the best number to reach you at, Kirk?
720-605-3900. That's 720-605-3900.
Fantastic. Great. Thank you, Kirk. Well, I appreciate you being on here with me today. Because important information that you've given us, a lot to think about. I'll probably be going to my local bank this week and saying, I'm going to pull a little bit of cash and just stuff it somewhere. But anyway, thanks again. Take care. And I'll probably see you next week then.
Sounds good. We'll see ya.